Despite current macroeconomic challenges confronting the Nigerian economy, the financial sector has remained resilient and strong and, of course, profitable. According to the report, 13 commercial banks in Nigeria increased their earnings by 25% in the first quarter of 2022, recording a total of 1.54 trillion naira. The banks were able to record improved bottom line despite the CBN monetary policy leaning towards a dovish direction, that is, keeping interest rates low. The 13 banks includes Ecobank Transnational Incorporated, Access Holding PLC, Zenith Bank PLC, United Bank for Africa PLC, FBN Holdings PLC, United Trust Holdings Company and PLC. Others are Fidelity Bank PLC, Stanbic, IBTC Holdings, FCMB Group PLC, Union Bank for Nigeria PLC, Sterling Bank PLC, Wema Bank PLC, and Unity Bank PLC. Well, let's get deeper into this and understand what it means. I'm being joined via Zoom by the Managing Director and Chief Business Officer of Optimus by Afrinvest, Mr. Ayodeji Ebo. Mr. Ebo, thank you so much for your time. It's good to have you on the show.
Thank you for having me. Good afternoon.
Yes, a lot of money here, earnings increasing or rising by 25% to about 1.54 trillion naira. I am wondering that how are the banks being able to wade through all of these economic challenges at this time, and they're still getting out with this remarkable kind of profit? What is playing out?
Okay, thank you. And before I would respond to that, just give a bit of background on how the banks make money. So when you look at the books of the bank, there are two, in terms of classification, two major income lines. We have what we call the interest income, and majorly the interest income is the income they make from loans, while the also the income they make from investment securities. So when they invest in government instruments or even for corporates, the income they earn. So that forms the major part, which is about 90, when you add the two, about 90% of their total interest income. And you also, when you also look at the non-interest income, which is basically you have the fees and commission, you have when they charge the management fee for loans. That is also where their trading income also comes in. So looking at the variable that have resulted to the increase that we have seen. So when we talk about the gross earnings, which you mentioned, it is the summation of all the income lines of the banks, both interest income and non-interest income. Yeah, so what we have seen is that the non-interest income element has been boosting the income or the gross earnings of the bank, especially when you look at the trading income. The trading income can come from investment securities, that's investment in the FGM bonds and treasury bills, and which we could link to higher interest rate environment. So when you look at 2021, you see the interest rate environment was still very low. And as a result, a lot of the banks did not make as much income from that. Also, FX gains. So we saw a lot of banks record significant FX gains. When you look at the results of GT Bank, for instance, in Q1, I think about 13 billion alone was raised from FX revaluation gains. So most of the banks always devise one way or the other. So despite the choppy environment, they try to see how they want to devise one or two ways to boost the income. And sometimes if you want to normalize even this income, you may want to take off, by the time you take off some that you may classify as one-off, because sometimes the trading gains, it's depending on market movement for most of them. When we see an adjustment even in the Naira, you would see that a lot of they will also want to revalue their positions, which would boost their income. Some of the banks are also done a bit of they've done some swap arrangements with banks or with the CBN. So any revaluation gain is also positive for them. So you would see beyond the plain vanilla interest income from loans, from investments in government instruments, other income has been the major boost that we've seen. But it's too early for us to conclude that this would be sustainable, because sometimes when you see the non-interest income, especially from trading income, it can be one off, because it's always based on major movements in the market.
Brilliant stuff there. But if we are to place the bank's profit, of course, alongside some complaints and challenges, of course, of customers and all that we see, are these big gains really justified? Some customers will say, no, we have issues, we are not satisfied, and all of this. What's your reaction to that?
Yeah, so I think two things. The banks, they are private business, and once it's every private business wants to continue to make profit. So even if you declare 200 billion this year, even your board will want you to do better. But I agree with the customers that we shouldn't be focused on even profitability alone. We should be focused also on what kind of customer service are we getting. Because some of them, when they get too big in terms of customer satisfaction, decline, which is where the fintech are coming into. They are coming in to solve. There are a lot of the big banks now that used to go after customers, give them attention, are now trying to focus on the high-end customers, leaving the retail customers, forgetting that for some of them, when they started then to grow their retail base, they started with those that don't even have enough, and these are the people that are supporting the banks now. So the customers have a point. There needs to be, as your profitability also improve, you may need to spend more to also see how you want to satisfy most of the customers that are banking with you, so that they become very loyal. And as a result, when you see return business, they're able to put more of their funds with you, then you also be able to make more income.
I'm looking at these big funds too. Is there any way you think the banks can also give back, maybe better than they are doing at the moment?
Okay. Yes, I think that while when you look at there are some taxes that are mandatory that governments that they pay out of their profits. Some have also engaged in some form of CSR, but I feel that they can also do better. So, for instance, we could see what Dangote Cement has done with the tax credits structure that the government has put in place based on the tax that is being paid. I think MTN2 is also doing something like that. I think we need to begin to see the banks also see how we want to fuel their presence in the economy in terms of infrastructure. So beyond just lending, so this tax credit structure where you use your tax to build roads, and that would ease that will ease doing business in Nigeria. I think we need to begin to see more of them. And in terms of CSR, I feel, yes, they are trying, but they need to also do more to look at the retail sector. There are some banks that are focused on the SMEs, trying to build their businesses to support them. In terms of capacity, when you look at the SMEs, they need to build a lot of capacity. So not just about financing, that is always the challenge. There's a lot that needs to be done in terms of capacity. And most banks are also very conservative in terms of taking risks. It's always very rare for them to fund new businesses. They fund businesses that are already profitable, businesses that can generate cash. While I understand that, yes, in terms of risks, it's good to be sure that the business is stabilizing, there needs to begin to set something aside from their profits to be able to take more risk in terms of investing in startups that, yes, they may have the idea, they can groom them and train them, and they are able to grow big. Yes, some of these startups, when you look at developed clients, when they invest, maybe out of the 100 companies they invest in, maybe only 10 may survive, but that 10 will be able to yield the income that will cover the loss from the other 90 as we progress. So if we begin to see that kind of support, then even our economy will begin to feel that impact.
Let's move further. We normally talk about their shares, the banking shares, or shares of banks remain very, very liquid at all times. Would you advise investors at this time to key in or to invest more into banking shares in Nigeria?
Okay, thanks. And the top banking stocks have always been very consistent in terms of dividend, which provide cash flow for investors. So I would advise that we currently, the stocks, they are trading at very cheap multiples. You see the likes of even GT Bank that used to trade at as high as 2.4 times price to book multiple is down to about 0.8 times. So that provides an opportunity even for Zenith. Most of them are trading below one time the price to book. We present opportunities, long-term opportunities. But beyond even capital appreciation, when you look at dividends, some pay as high as 3 naira dividend, likes of Zenith per annum. So you compare that to the price, that's about maybe 13-14% return. When you compare that to the yield you get from 1 year treasury bills of about 6%. So you can see that it's one way that you can be able to bridge inflation. So you get 15% and inflation rate is around 16.8%. You've been able to reduce the impact. And if you have that long-term perspective, yes, so I won't say for stocks, the price can decline. But when you look at your cost, if you lock into, this is not a recommendation, but if you like, for instance, you lock into Zenith at 21 naira, even if it comes down to 17 naira, as long as you don't sell, you have not crystallized the loss, but you continue to get dividend based on your cost. If you continue to get 3 naira and they grow their dividend 3 naira 50 the next 3-4 years, then when you look at the return you'll be getting annually, will be as high as 13-14% based on the cost of investment.
Let's wrap up on this note. Can the economy possibly grow with the current interest rate regime carried by commercial banks?
Okay, thanks. And it's the chicken and egg situation, and because when you look at also the cost of doing business, it's also very high. And what the bank also look at is, I was looking at the books of GT Bank, their first quarter results, and looking at their OPEX, you would see how AMCON stood out 11 billion just for 1 quarter. That means if they go at that same rate, that's about 44 billion naira going to, which is going to be part of the cost they will have to cover. So as they create credit, they have to be able to cover that cost. So when you see, most times when they want to fix their lending rates, there's a lot that goes into it apart from the cost of funding. They look at the NDIC charges, all those other charges are also part of what they had before they now look at the spread that they desire to make depending on the risk within the sector. So now being direct to your question, I feel the interest rate environment is high because even with the cost of doing business, it's a major pressure point for a lot of businesses. So by the time you also have that high interest rate, it will be very hard for you to be very profitable. And if for companies that are in sectors that have inelastic demand, that means people cannot do without what they sell. So what you typically see is that they push that cost to the customer. So we all pay more when they produce those goods or they provide those services for us. So it will be good to also be able to manage and keep the cost of funds at a reasonable level for companies to be able to survive.
All right, it's a good way to leave it. Interesting conversation as usual. There I've been speaking to Mr. Ayodeji Ebo, who is the Chief Managing Director and Chief Business Officer of Optimus by Afrinvest. Do enjoy the rest of your day. Thank you for your time.
Thank you for having me.